Welcome back. With visions of more rate cuts dancing in our minds, here's a look at the possible path by the numbers. The central bank rate has been at 5% for almost a year, 11 months to be exact. The bank raised it from 4.75% last July, seemingly its last hike in a series of 10 starting in March 2022. The bank's focus is on inflation. It expects it to fall to 2.5% by the end of this year and return to its 2% target by 2025. That doesn't mean rates will go back to 0.25%, which is where they were in 2021 when inflation got going. Still, a decline in lending rates should help borrowers a little. Currently, the average mortgage rate in Canada is 5.36% for a 5-year insured fixed-rate loan, 5.54% for a fixed-rate uninsured loan. Meanwhile, the average variable rate mortgage, which will float along with the Bank of Canada's moves, is 6.75% insured and 6.8% uninsured. So what kind of difference will this week's 1/4 point cut make? A buyer who paid $700,000, or the average price in Canada in April, for a home at a mortgage rate of 5.95% would have a monthly payment all in of $4,157. Assuming a 10% down payment, after that rate cut, the monthly payment does drop, but by just under $100. The market is clearly waiting for rates to fall further. In February, residential mortgage debt was $2.16 trillion in Canada. That's up 3.4% year over year, but that's the slowest growth in 23 years. And for those with mortgages coming due in 2025 and 2026, even a rate cut of a full percent is still almost double the 2.15% variable rate they may have locked in at back then. Even if the difference will be small to begin with, there is obviously a lot of hope that the housing market will revive as rates come down. But we have to ask, is that necessarily a good thing? Marc Desormeaux is principal economist at Desjardins. Thanks for being with us.
Great to be here with you.
So let's start with what you think the impact of the rate cut will be. I mean, it signals, and the bank made it clear, that it's a kind of a pivot moment. They do expect more ahead. What do you think will be the effect on housing?
Well, we actually just put out an outlook at Desjardins, and this cut was consistent with our expectations at that time. We think rates will come down further over the course of the next couple of years. And so, we think that this will help to stimulate prices and sales up from where they are now over time, over the next few quarters. But we might not see the kind of rebound that we're accustomed to, particularly in the highest price markets, during a period of lower interest rates, just because affordability is so stretched across the country.
And of course, one of the issues that we have in housing market has nothing to do particularly with the lending rate, and that's simply supply and demand. The other kind of piece of the equation is whether builders feel relief from rates and borrowing costs. How much do you think they need to see before it makes a material difference in the pace of building?
I suppose the short answer is more relief. Borrowing costs are certainly a big part of whether decisions to finance new construction go ahead, but they're not the only part of those decisions. And in our report, we talked about how the outlook for housing starts for residential construction in Canada isn't as positive. We look at, for instance, building costs, materials, labor costs. Those have actually risen. If you look at Statistics Canada's residential building price index, since the start of 2020, that index has risen by almost 60% versus just 16% for total CPI. So costs are still just very high within this industry. They represent a major barrier to new construction, alongside things like labor shortages and regulations that sometimes limit our ability to build more.
Perhaps one of the biggest kind of questions for homeowners, especially those who are resetting mortgages in the next couple of years, will be, where do we land ultimately? What will be the new normal for the central bank? It seems to me our central banker is saying don't expect to go back to where we were. Do you at Desjardins have a view of where that new place is? Is it 4%? Is it 3%? Where might we see that interest rate land?
We would agree that we're not going back to the ultra low rock bottom stimulative rates that we saw in some of the years before the pandemic and then at the peak of the pandemic. We'll be updating our forecasts over the next couple of weeks. But, what we sort of think is that there are more rate cuts to come later this year. if inflation continues to cooperate. And with a slowing U.S. economy, weaker population growth in the next year, something around 3.5% near the middle of next year is certainly possible.
And I guess I should ask, the bank seems reasonably satisfied that we've got a just weak enough economy, which is sort of their intention with the higher rates, but not too weak. Are you in the camp that thinks we do skate past anything really bad here, no big recession?
Our base case does not include a recession in it. That means we're not anticipating 2 consecutive quarters of GDP declines or big, broad-based job losses. But I would point out that GDP per capita in Canada has fallen in 6 consecutive quarters. So even though the economy is continuing to grow, continuing to churn out jobs, it doesn't necessarily feel all that strong. So in that sense, given that we have had that persistent weakness in income per person, this feels like a recession to a lot of people.
Marc, so good to have you for this. Appreciate your time.
My pleasure, anytime.
Marc Desormeaux is principal economist at Desjardins.